heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Ed Ludlow in San Francisco. Caroline Hyde's at Bloomberg Invest, but this is Bloomberg Technology. Coming up, full EV coverage ahead as Rivian and VW forge a $5 billion partnership. Plus, the Supreme Court clears the way for the White House communicating freely with social media companies to seek the removal of what officials see as misinformation. And we go live to our Bloomberg Invest Summit, where heavyweights across the financial industry break down the most pressing issues facing investors. Right here, right now, let's get right to our top story, and that is a deal between Rivian Automotive and Volkswagen. The shares really taking off. In after hours, they were even higher on Tuesday night. Rivian, as it stands, is trading at its highest level since February. If it closes at this level, it will be the biggest gain one day on record, although I'd caution following the IPO in November 2021, we did see swings in excess of 50%, and it did not close near those levels. This is a company that I've covered very closely for years. I have to be honest that I didn't see this one coming. Basically, in the first instance, Volkswagen will invest $1 billion into Rivian in the form of a convertible, unsecured or unstructured note due December 1st of this year, and then commits to investing $1 billion in 2025, $1 billion in 2026. But we don't know where the share price will be at that time of Rivian, right? In return, they form a JV, but Volkswagen gets access to Rivian's technology, both software and some elements of the drivetrain or powertrain. This is a big one for the EV industry. Let's get into detail with Stephanie Valdez Streaty. Stephanie is the Director of Industry Insights at Cox Automotive. A quick disclaimer. Cox Enterprise, which is the parent company of Cox Automotive, is an investor in Rivian, and Sandy Schwartz, CEO of the Cox Family Office, a member of the Rivian Board of Directors. But we have Stephanie here for her expertise on this company, these companies, and expertise on this industry. So let's start with the basics. Stephanie, your reaction to this deal.
Well, Ed, I think what you hit it when you said this was an unexpected announcement, and it's making waves through the industry. And I think it's huge. It's a breakthrough moment for Rivian. As you know, we've been following Rivian also, and although they've made some really good progress in the market with their products, with their customer experience, you know, becoming profitable has been a big issue. And so this investment is huge. It's going to help them really get on that road to profitability, especially as they're trying to launch the R2, which is a very critical vehicle for them in terms of affordability in the marketplace and kind of in that segment where there's more volume. So I think this is a huge moment. And I think for VW as well, right? Having access to that cutting edge technology. And I think the opportunities for global expansion for both companies is really going to be a positive for both.
When the news broke last night, I took a few phone calls, and what was so interesting is very quickly, a few folks close to Rivian and at Rivian and elsewhere in the industry would point out to me, Volkswagen's software strategy has not gone that well. They kind of formed Cariad, the unit and the Cariad platform. I'm told they faced some major issues. How much do you think this is sort of Volkswagen reacting to that versus actually pretty much an acknowledgement that Rivian is good at software?
Yeah, I think it's Volkswagen's acknowledging that Rivian has this cutting edge technology and it's going to really help them to scale. And I even think about broader, like if you think about the Chinese automakers and just kind of what the penetration that they've had and the technology that they've had. So I think this is going to really help VW, not only in the North American market, but globally as well. So I think they really saw that this is something that's really going to help their brand and really help them scale faster and more efficiently.
I have to be honest with you, Stephanie. Rivian's track record in joint ventures is not good. You know, I've been covering this company since the moment that RJ was on stage at the LA Auto Show and revealed to the world that he had a pickup and SUV. And within, 3 or 4 years after that, the Ford JV had been and gone. Ford invested $500 million in Rivian, and then they planned to build a Lincoln together. They scrapped it. They planned to build a joint venture EV together. They scrapped it. The Mercedes relationship on commercial vans lasted 3 months. How much of a cautionary tale is that for Volkswagen?
No, I definitely think they need to be cautious, especially in these two distinct companies, right? And they need to constantly make sure that their strategic goals are aligned. So I think to your point, it's going to be, it's going to be a long, bumpy road, but I think they're going to have to be very focused on making sure they're aligned. And kind of what you just mentioned about some of the failures in the past. So I think it's definitely something, a risk, right, that they need to closely follow and make sure that they're aligned.
You and I spoke very recently about market share. So Rivian is going to come to market in 2026 with the R2, and that probably will be a competitor for existing models like the Model Y. But at the same time, Tesla is ceding some market share in North America and other markets as more models join the market. How are you tracking that, and how do you see that going?
Yeah, I definitely see, like, it's all about product, right? Customers like new product, and with Rivian having the R2, R3, adding more vehicles into the marketplace, I think that's going to really, in terms of like Tesla not having anything other than recently the Cybertruck, and no definitive timeline for the more affordable vehicle, I think Tesla definitely has more and more competition, and not only with Rivian, VW, but other makes as well. So I definitely think Tesla is really going to need to get some product into the market to maintain that share that they've had for many, many years.
I've got a stat for you. For the 12 months through May, Tesla sold 618,000 electric vehicles in the United States. All of the other manufacturers combined sold a BEV 597,000. So at some point, I think we expect that to cross right. But the question it raises is one that RJ Scaringe has argued with me about over many years. He says that this isn't an issue of interest rates or tepid consumer appetite towards EVs generally. He argues we need more models. The more models we have on the market, the better the market will be. Do you share that thesis?
Yeah, I think we need more models, but more affordable markets, right? If we want mass adoption, we need to have more affordable models. Price is the top barrier for consumer adoption. And so as we have more and more affordable markets or models in the marketplace, that's going to help with adoption. So I think I agree with that. More models, but more affordable models is going to be critical.
Cast your eye to the future. What happens with Rivian, Stephanie?
I'm betting on them. I think they have a lot of good brand equity in the marketplace. I think the VW partnership is really a lot of great potential. And I think their collaboration can really evolve this whole connected software-defined vehicle technology. And so I think it's promising. But like you just mentioned, I think they just need to be careful that their strategic goals are aligned and they're in lockstep to ensure success.
Stephanie Valdez, Streaty of Cox Automotive. I just appreciate your insight, not just to Rivian and VW, which I think caught us by surprise, but the industry at large as well. Thank you so much. Okay, let's turn to some breaking news that's come out in the last hour. The Supreme Court cleared the Biden administration to communicate freely with social media companies in an election year which rules that bolsters the government's ability to seek removal of what officials see as misinformation. I want to bring in Bloomberg's Kayleigh Lyons out of Washington, D.C. Kayleigh, I saw the headline cross and I've just read the intro to you, and I'm trying to understand the mechanics and bigger picture of this story. Explain it to me.
Well, Ed, technically this is a win for the White House. You're exactly right in that it leaves the door open for them to communicate freely with social media companies about content that they see as misinformation that could potentially be harmful to the public. This case all started with questions around the administration's activity with social media companies and trying to control information related to the COVID-19 pandemic and the 2020 election. And the plaintiffs in this case essentially argued that they overstepped the constitutional bounds of the right to free speech. The thing is, in this ruling, which was 6-3, the majority opinion written by Justice Amy Coney Barrett doesn't actually talk about the merits of the case. It's about standing. They essentially argue that the plaintiffs, which included 2 states and a handful of residents within those states, did not have the standing to be bringing this case because they couldn't demonstrate that they were directly injured by the defendants, which, of course, in this case is is the Biden administration. So this is kind of similar to the mifepristone ruling we got earlier this month, where they didn't actually decide necessarily definitively on access to that abortion pill. It was just that the individuals, people that brought the case did not have standing, which is why they ruled in favor of keeping access to it. So it leaves the door open, Ed, for this question to still be raised again in the future, technically by plaintiffs who may have more firm ground to stand on.
There's an interesting case of what happens next, because per the ruling, the administration could go out and engage with the companies and talk to them freely. That is the top line of the story. Whether they do or not remains to be seen, because in October there was a temporary halt per the court. And as we keep pointing out, it is an election year. What does Biden and co. do?
It's an excellent question, Ed, and we're just going to have to wait and see, because, of course, all of this is going to be viewed through a political lens. There is a huge conservative thought in which the three ultra-conservative justices who dissented in this decision, Thomas, Alito, and Neil Gorsuch, that do think the administration may be violating the rights of free speech, specifically restricting the speech of the right and of more conservatives. And this is something that we see trickling through all through American politics at this time, all the way up to the presumptive Republican nominee, Donald Trump. So these decisions for the administration to be engaging with social media companies on what content can be propagated and seen by the people is very much politically tinged. And I would just note, Ed, it isn't just about what the administration does, but what social media companies themselves do. And I would point you to the fact that we are still waiting a ruling this term from the Supreme Court, so it should come within the next several days, on laws in the states of Texas and Florida that restrict the ability of the social media companies themselves to police misinformation. And the court has yet to rule on that particular question.
Bloomberg's Kayleigh Lyons, co-host of Balance of Power. I watch Balance of Power, and our Bloomberg Technology audience should as well. Thank you so much. Okay, coming up on this show, we're going to be joined by Jack Mallers, CEO of Strike, to discuss the launch of the global Bitcoin app in my home country, the United Kingdom. I'm also taking a look at shares of, guess what? Nvidia, actually softer again, down 2.7%. Let's call it a roller coaster ride. We were down 3 days straight with a technical correction. We rebounded, and now we're down again 2.5%. There's the annual general meeting taking place straight after this program. Usually it's not a news event. Usually it's not that closely followed. But I wonder if this time it may well be. I'll be on hand, and so will Bloomberg's Ian King. Be right back. This is Bloomberg Technology. Okay, time for talking tech. And first up, CME readies for trading via the cloud. Google will work with the exchange operator to build out a new network that would move futures and options trading to the cloud. The two firms will develop new facilities next to CME's existing data centers, with construction due to start later this year. Plus, SoftBank's AI ambitions start with healthcare. Founder Masayoshi Son is set to host a panel with doctors and medical professionals on way to harness AI for the health sector. One company he's expected to bring up is Tempus AI, a US startup that's backed by SoftBank that analyzes medical data. And South Korean chip makers are about to get a financial boost. The country is going to inject $19 billion in support to build out the semiconductor industry. Starting in July, eligible firms could tap the program at the market's lowest rates. This comes as countries worldwide are moving to make chips locally due to global supply chain concerns. Those are some of the news stories we're following. I want to get to the world of crypto. The global Bitcoin app Strike has now launched in the United Kingdom. Delighted to say that Strike CEO Jack Mallers joins us now here on Bloomberg Technology. I found this so interesting. Without boring you with it, I moved to America 6 years ago, but at that time when I was covering technology, London in particular, I would say, and the consumer base was much more focused on fintech and crypto than perhaps other areas of technology. 6 years on, you guys have made the move to that market. Why?
I think simply put, we view Bitcoin as a paradigm shift. I think Bitcoin is the first time humans have come across perfect money as we know it. And the world needs a global Bitcoin company that's going to help them and provide them the financial services to adopt it. And so I think we are the most accessible, global, and most performant Bitcoin business in the world. Like compared to a Coinbase, we don't focus on 1,000 other cryptos and our own blockchains and stuff. We just make sure that people have an amazing experience adopting the best money of all time. So that's why the people in the UK need Bitcoin, brother. Come on.
Well, Jack, I find that interesting, though. So if you think about Strike as a platform or an app, call it what you will, you can do several things, right? You can buy and sell Bitcoin. You can make lightning payments. There's other functionality. But is there a specific use case that you think people of the United Kingdom will use most? In other words, was there a clear demand for a specific function?
Yeah, well, I think Bitcoin's the best performant asset in the history of our species. And so people want the best experience. That's kind of our baseline. And we've become that. And that's why we've been on such a tear expanding globally is everyone wants our product. I think that where we are in this market cycle, given the geopolitical backdrop and the macroeconomics and this upcoming election, is people need to buy it. There's going to be a lot of new capital that is going to come into this asset class. It's my prediction. I've told you, I think Bitcoin's going to land somewhere between $250,000 to $1 million per coin over the next 12 months or so. And so that is the highest volume product we have is people that call us and say, I need this thing. Can you help?
One of the headwinds or challenges, what you've outlined, and yes, you've outlined it before on the kind of direction of travel of Bitcoin, is regulation and oversight. You know, we're focused on the UK. It's just one market in the 100 or so you operate in. But what was that experience like launching in the UK, having to work with post-Brexit regulators who, as we discussed a lot on this show, Jack, they have tried to be strong, right, particularly on newer areas of markets or nascent technology?
You know what, Ed? Listen, I think that everyone can agree, both regulators and us, there's a lot of work to do in education, and there's definitely efficiencies and progress we can all make. But the fact that we're Bitcoin only, I can say was huge. No one is diligencing the fact that we're creating our own tokens. If something is a security, if I'm acting unethically, I build and sell the most honest, performant money in the history of our species. And it's a very simple business. It's a very honest business. It's a very moral and integral business. And so it's been rather simple. While other businesses are retracting from markets and getting sued by regulators, we're not. And I think it has a lot to do with the fact that we're built on principle. And I founded this business because I think Bitcoin's going to change the world and I want to help. And so with that context, it was fine. It was fine. And we're pleased with the launch.
Jack, really quickly, we never really talk about Strike as a company. Are you going to be employing people in the UK? Have you grown your staffing there? Have you got yourself a nice office? What does it look like?
Yes, we will. Strike's growing a lot. We, though, take this approach where we have two businesses. We have our operating company and then we have our treasury business. And we buy as much Bitcoin as we possibly can. So Strike's a profitable, growing business, and we sweep those profits into Bitcoin. Over 90% of our treasury is actually in Bitcoin. So the cost of capital is against Bitcoin. So we only deploy capital into things that we think can outcompete Bitcoin, which is at an annualized average of 63% over the last 10 years. Right. So we're delicate with how we invest, but of course, I mean, Strike's a monster, and we're going to keep pouring capital into it as long as people keep needing Bitcoin and us.
Strike CEO Jack Mallers, appreciate your time as always. Thank you so much. All right,
Thanks,
coming up on Bloomberg Technology, we're going to be joined by Richard Robinson, CEO of Robin AI, to discuss the company's new product line and its role in the legal AI race. A quick look at shares of Apple as well, up more than 2%, an upgrade at Rosenblatt. Basically, simple argument as they upgrade to buy from neutral. They see Apple as having the potential to take market share in AI because of its privacy focus in Apple Intelligence. Be right back. This is Bloomberg Technology. Time now for our weekly AI in Action segment. And today we're looking at the field of legal AI. Robin AI works to enhance efficiency by automating much of the due diligence process that's involved in M&A. The company also announced their new product line, Robin AI Reports, this month. Delighted to welcome back to the program CEO Richard Robinson. I think you and I have discussed this in the past. Like, I am a student of the law, went to law school, a family of attorneys, and thank goodness I didn't become one. but I get the point of Robin AI. Let's start with the new product line, the reports element. What is it, and why did you feel the need to bring it out?
Yeah, sure. When I was a lawyer, one of the most painful things I ever had to do, is something most lawyers spend their time doing, is working through hundreds and hundreds of contracts, trying to summarize those agreements for our clients. People want to know what's inside all of these documents before they do a transaction. And unfortunately, in the past, we've just never had technology to help us. And so we employ armies of associates through the night, week in, week out, to basically go through these documents line by line, looking for risks that they can report. And so we said, why can't we build something that uses AI to do that for us? That's essentially what our reports product does.
The field of legal AI is widely discussed. We recognize a two-horse race, basically. You have an association with Anthropic. Yeah. There is another legal AI named Harvey we've had on this program, closely aligned to OpenAI. In fact, I think OpenAI made an equity investment in them. Yeah. You going to win that race?
Of course. I mean, we are legal AI for business, and Harvey and OpenAI are really focused on law firms, and we think that's interesting, but what motivates us is trying to help companies like Bloomberg, like General Electric, like PwC, helping them do their work faster, unleashing them to grow in ways that they can't today, because in the absence of the right technology, managing legal risks is just time-consuming, it's expensive. But if you use tools like ours, we have customers saving 90% of their time.
Could I have some data then? How many M&A transactions has Robin AI facilitated, for example?
Yeah, I mean, we've been involved. It's worth saying, we've been doing this for nearly 5 years now. I mean, we support M&A transactions. We support about 1,000 transactions a month already for some of the world's biggest companies, for 5 of the Fortune 500, for 7 of the top 100 funds in the world. We've been really working with business since 2019, long before LLMs, to help them use AI to accelerate deals. And working with Anthropic has just helped us expand our reach and focus.
Robin AI CEO Richard Robinson, it's great to have you back on the program and keeping us up to date. Thank you so much. Coming up, Micron's out with earnings later today, and we have all the details on what to expect next, plus getting a bit hands-on with some of the tech. We're also looking at shares of Paramount. A headline out this morning, discussion about Paramount looking at global options, global partnerships for streaming services. The saga continues about the future of Paramount, its assets, ownership, and what happens. But for now, the stock's down 1.3% in the session. It's a story I'm sure we'll continue to track in the next few weeks, because from an M&A perspective, or even just a streamer perspective, it's something that I know our audience really cares about. Stay with us. A lot more to come on the show. This is Bloomberg.
We got hands-on with NVIDIA's AI accelerator, the H100.
But this little one is pretty important too.
It's Micron's HBM3E, a high-bandwidth memory chip used to power AI workloads. The tech's revolutionary for the industry because it allows for high-speed data transfers and more capacity, both bottlenecks in developing AI. Producing the chips is complex, but the payoff is great for Micron, Samsung, and other players. The Micron chip's smaller and thinner than a penny. It's key to training LLMs for generative AI. Basically, the more data you can serve up more quickly, the better the model gets. There are 8 layers of DRAM or memory stacked on top of each other. Each layer is 3 gigabytes, so together you get 24 gigabytes.
The reason that Micron's HBM3E or high bandwidth memory is important is that in the AI context, it solves for a problem called the memory wall.
To train the LLMs behind ChatGPT, for example, you need to be able to process a large amount of data very quickly. As AI workloads increase and NVIDIA releases new higher performance AI chips like Blackwell, the memory demands also increase. This year, Micron also released a higher capacity chip that stacks 12 layers of DRAM, so 36 gigabytes of memory. The two look identical when placed side by side. Each layer is made thinner to provide more memory without taking up more physical space.
The next in our series of getting hands-on with semiconductors. A quick look at Micron shares, softer by 0.5 percentage point. Micron is scheduled to release its third quarter results after the market closes today. And a big focus on when's the AI story going to hit in top-line growth? Here with expectations is Bloomberg intelligence analyst Jake Silverman. We focus on HBM3E or high bandwidth memory, but that's where the street's looking as well, right?
Yes, certainly. Investors are definitely going to be looking at expectations for high bandwidth memory growth for Micron, both in fiscal 24, but also looking at calendar 2025. Micron's management has what we think is a pretty reasonable goal of reaching mid 20% bit share for HBM by 2025. So
historically, Jake, memory is a kind of highly cyclical and almost commoditized piece of technology. Does AI change that? Because in the context of AI accelerators or GPUs, we just talk about this addressable market in an exponential growth curve.
Yeah, so it's definitely different. You definitely don't have the same commodity-like cycles, or same commodity-like expectations for HBM that we would typically see with memory markets. This is definitely a secular trend that's really being driven by AI. And in terms of HBM capacity, they're actually supply constrained right now, memory suppliers. So they're getting margin advantages right now relative to standard DRAM. So as HBM continues to grow in terms of revenue, that should also lead to margin expansion for memory suppliers as well.
I'm really interested in how much Sanjay Mehrotra, the CEO, gives us a crystal ball into the future. Because in the first instance, HBM3E goes with H200 generation of NVIDIA's AI accelerator. But in the future, you have Blackwell. Maybe he'll tell us how much money they make. But I'm interested in the landscape. Samsung is looking at high bandwidth memory. You have SK Hynix. Where does Micron sit in that competitive field?
Yeah. So SK Hynix has been the leader. They've really been sort of the sole supplier to NVIDIA's H100 chip. But as we look at H200, Micron seems to have gained a decent amount of share there, and we're expecting Micron to gain share into their Blackwell chip as well. But that's not the only opportunity for Micron as well. They can continue to gain share in other GPUs, accelerators. There's a lot of options. AMD as well as one example. Google's TPU is another opportunity. All of those chips require high bandwidth memory.
There is some other stuff that we should talk about. I mean, DRAM generally, NAND or flash memory. What are some of the other important areas of Micron's business?
Yeah, so there's also, staying on the topic of AI as well, aside from HBM, they actually still have products that are related to AI growth. High capacity memory modules for DRAM, enterprise SSDs, all of those are starting to see an inflection related to AI revenue. But generally speaking, the market just looks a lot healthier. As we think about supply constraints and limited capacity this year and potentially into next year as well, we're expecting pricing to continue to increase for non-AI related products for Micron.
Okay, put you on the spot. What are we expecting then? Give me the top line growth numbers and where BI sees the print this evening.
Yeah, so we think that Micron will report above the mid-range of guidance for both revenue and earnings. And as prices continue to increase throughout this year, that could lead to upward estimate revisions across the street for this year and into potentially next year as well.
You are new to the show, Bloomberg Technology, but we're grateful to have you. What else are you working on in the field of memory right now? It's a big coverage area. We talked about how historically it behaves like a commodity, and it's also a global industry as well.
Yeah, so we've already done an HBM sort of market forecast that goes out 5 years to 2028. So that's something that we're continuously tracking and looking at. But on top of that, we're also just looking at for non-AI related products, what capacity is going to look like throughout this year and next year to try to understand what that supply-demand balance looks like. So that's just ongoing work that we're continuously looking at, how that impacts pricing and ultimately demand for the company's products.
Bloomberg intelligence analyst Jake Silverman, as you can tell, I could talk about the memory market all day long. Thank you. Now, Bloomberg Invest is underway in New York. Let's get to the live event. Our very own Caroline Hyde is sitting down with Canvas Ventures' Rebecca Lynch and Lycos Global Management's Nick Laster.
And general partner at Canvas Ventures with Bloomberg's Caroline Hyde.
Kind of at either end of the spectrum here when it comes to private investing, going into public investing. And I want to sort of launch straight in on what on earth it is like to be writing checks at either end at the moment. So with Lucas, of course, Nick, you are looking much more at the late stage rounds, IPOs, maybe just very recently gone public companies. And then Rebecca, with you, you're more in the Series A, the Series B. So Rebecca, kick us off.
Yeah.
Is it competitive?
You know, it is competitive. But for how we approach the market, we really have a lot of runway in front of us because we spend a lot of time on our core investment theses. And now with Gen AI, which who hasn't heard of that, right?
I've never heard of it.
Never heard of it. There's so many really interesting opportunities from founders that have done multiple exits in the past, multiple companies. And so we've done 3 this year, and the pricing is back down to pre-21 levels, all with the Gen AI focus. But you have to really know what you're looking for, and you have to know what to avoid.
Okay, so Nick, if we're looking at Lucas's approach right now, you're, of course, come out of Soros, raising your own fund, already in CoreWeave, for example, which is one of the pinups in AI. Was that a hustle to get into? How competitive is it?
It was. I think it's the onus is on investors to do something other than just write a check, because capital is something of a commodity. For us, and particularly with CoreWeave, Mike, Brandon, and Brian, it came down to our ability to help them tell their story in a way that was going to resonate as they transition to public markets.
That's a PR's job, Nick.
But no, it's an exceptional asset. We were humbled to partner with them. But it requires investors to hone and clearly articulate their value prop.
So we already have brought up Gen AI. So Nick, if a company right now is at the upper ends of raising money, actually might even be eyeing the public markets, does generative AI have to be in their story? That's your key selling point. You can help companies tell a story. Does it have to be a Gen AI story?
It certainly doesn't hurt. I think companies that have AI exposure or credible AI story are certainly in a very different situation when it comes to IPO demand. If you look at deals this year, 2 come to mind, both successes, Reddit and Astera Labs, March IPOs. Astera was a pure play AI narrative, and Reddit was a complementary AI narrative. They're up 60 and 80%. But irrespective of whether or not you have a credible AI story, if you're a CEO, if you're a founder thinking about going public in the next 2 to 3 years, I think the things that really matter, identifying partners that you can see yourself growing with, building a robust finance function, and identifying the KPIs that are going to drive value not only today, but going forward. There's always going to be public market demand, AI or not, for businesses that have durable growth, strong unit economics, and a line of sight on free cash flow.
Does that also ring true in the Series A, Series B space at the moment, Rebecca? How much are you looking at the public valuations and having to either down round it, or actually are companies managing to grow into their valuations at that stage?
Oh, for our companies? So for us, we're early growth. So we're Series A and B when the companies have a product we can get our hands on. And then what we're really good at is helping them scale and develop their go-to-market. And that, like a strategic consultant, just like you said, companies now, really, especially the experienced CEOs more than ever, are looking for investors, whether it be my stage or yours, that can really be a partner with them and help them strategically go through the process, right? And so it's very important for us that, I always tell founders they need to know where they would land the plane if they had to, right? and how that would work. And so we work very early on like, what would it mean to be profitable? What people in our ecosystem do we need to actually partner with very early? And we encourage our founders to go out and do that years before the IPO word even comes into their board deck, to really think outside of their existing company and think very strategically.
Rebecca, on that note, how often are those partnerships becoming M&A opportunities rather than actually going public via IPO?
Well, an M&A opportunity almost always comes from a partnership. It almost never comes from a cold start and a sale process. And just last year, Casetext was bought by Thomson Reuters, right, for $650 million.
Big AI play?
Big AI, probably, I would say, still the most robust implementation of GPT-4 that exists. And they did that because of partnership opportunities, both with all of the AI LLM players. They've been in that space for a decade, right? So they had the sandbox of GPT-4 in July of 22. And that comes from these really strategic outreach motions that they did. And then Thomson Reuters knew them well just because of their outreach they had done and the partnerships they'd done in the ecosystem.
What's interesting is we're seeing some rather novel types of partnerships and novel types of M&A actually going on at the moment, Nick. I mean, you're in CoreWeave, as we mentioned, they're trying to acquire an asset at the moment. But more looking at the large language model plays, OpenAI having relationships with Microsoft and others, but then you're also seeing Anthropic being funded by Google and Amazon and having partnerships. Then you get acqui-hires like we've just seen with Inflection.
I think it's called AI money laundering is one of the posts that came out, right?
I love that term.
She said it, not me.
There were some articles out there about that were pretty interesting, actually.
What would you say of these partnerships and M&A opportunities at the later stage?
Yeah, I think, look, in aggregate, it speaks to how integral these smaller private players are to hyperscale AI platforms and to offering end-to-end solutions and capabilities to their customers. And as it relates to Inflection and Microsoft, I think it also speaks to the regulatory climate, right? That was positioned and structured as an investment to license their model. You're also seeing a pickup in deal terms, regulatory break fees and the like. It's going to be harder for big tech to do big M&A.
Because of regulatory. Yeah. Well, and we saw that too with Casetext. I mean, Thomson Reuters came out just months beforehand and said that AI would completely disrupt their entire business. And they acquired Casetext, and Casetext, by the way, already had 10,000 of their own users. But they needed that experience and that platform really for their business going forward. And I think we're going to see more and more tech M&A for that reason from these very big players.
Interesting. Let's use Casetext as a case study. Because you, wrote the check into that in 2016. So this isn't an overnight success.
No.
But we do feel that generative AI has sprung up out of nothing, and suddenly there's a fight to get into these companies and valuations that just feel so extreme. How are you rationalizing what is a good AI opportunity or not?
Yeah, no, it's a great question. So we've been in, let's say, not Gen AI, but AI, machine learning, since we did Siri, when we were the first investors there. And then we've had a number of outcomes, including Figure 8 and Luminar in AI. And, although it feels like it came out overnight, right? And really the algorithms started like 2017. And so the companies that were best positioned to take advantage of GPT-4 were companies that were already in the space. I mean, Casetext, because they were taking the place of a legal counsel, had to be at really the bleeding edge of LLMs because they were writing text, right? And so they had access into all of that. And it was an evolution over time. But I've got to tell you, GPT-4 was just like a light switch. And the best comp and explanation I have is that the Casetext team had tried to pass the California bar with GPT 3.5. And the best they could ever get it to do was roughly 30%, score. Pathetic. Although the California state bar, the average is 68, so also not great.
Speaks the ex-lawyer.
Exactly. So but when they put GPT-4 against it, it was 94%, which was better than the lawyers. And that was in a very, very short period of time. So I think we just saw the step change incredibly suddenly. And the companies best positioned to take advantage of it were companies like a ship. They already had steerage and momentum going into it, and they could pick up the technology and plug it into their existing systems and customer base rapidly.
Look, it was a light switch, and it was also a light switch for many a market valuation. And we talk about NVIDIA day in, day out. It's now more than 3 trillion. I mean, it was at 1 trillion when we started the year. I mean, this is a phenomenal rate of growth. Nick, have you seen equivalents of this? How do you explain this to the LPs coming into your fund as to what the opportunity is for market capitalization growth?
Yeah, I think if you zoom out and you put this into context, from 2012 to 2021, on the back of extraordinarily low rates, you had US VC investment grow 8-fold. It was $330 billion in 21. You had more unicorns created in 2021 than you had in the prior 5 years combined. So there are a number of companies that have been overcapitalized, if you will, at a different cost of capital. Yesterday's cost of capital.
When it was zero.
About half of the unicorns last raised when rates were below 1%.
Wow.
So those valuations, while stale, can persist as long as cash burn and cash runways permit. There's some good data that's come out recently that would suggest that about half of the 740 unicorns in the U.S. Will need to raise by December. So I think it's a question of when, not if.
And are they, Rebecca, the right ones to be betting if they're running out of cash, but they have valuations that, need to be downgraded? Who are you looking at that is eyeing the public market but just can't at the last round that they raised at, I assume?
I'm sorry. So companies that are in this situation, right, are going to face just really one of two consequences. One, or three, unfortunately. One, they take their medicine and they take a massive down round. And hopefully the investors are on board with a complete recapitalization, which restructures the entire company. That's one option. And that we're seeing 30% of company or fundraising right now in that later stage actually be down rounds and largely inside lead.
Of the ones that are disclosed?
Of the ones that are disclosed, yes. Other ways they're doing this, I would say it's much bigger than that. People are just doing, a note document, right? Which is not disclosed. Good point.
So explain that, sort of a bridge finance.
Yeah, so it's bridge finance. So they do it, instead of doing like an equity financing and disclosing that, they do more of a safe note or a bridge of some sort where it's really sort of, debt capital going into it more or less, but it will take the form of equity. And then the other option is they sell the company to a public company. Now, the problem with that is these companies have incredibly high burn rates typically. Mm-hmm. Not ours, because we try to manage that very well, because we've seen the show a couple times. But, a company's not going to acquire a company for what has, is burning $5 million a month, which some of these still are. And then the third option is sort of the least favorable, is they just close. They go out and kind of quietly go away, right?
But a big company can't quietly go away.
No, we saw Convoy, not that long ago, go to zero overnight. And so I think we'll see more of that.
What we might see, though, is actually companies taking their medicine, Nick, and deciding to go public at a slightly different valuation than was the previous. And we've actually seen that already. Instacart swallowed that bitter pill, came to the market, and, well, people might question as to how well they've traded since. But I'm interested as to how much you see the opportunity for companies to make that bold step, to decide to go public, to become a publicly traded company with all the scrutiny that goes with it.
Yeah, I think there's certainly pros and cons to it. Look, it's a long road. I don't think, an IPO is the end in itself. It's a milestone on a multi-year journey, and ultimately, their success will be proven out in public markets as they execute. There has been a very acute, if not myopic, focus on headline valuations, but I think slowly you're starting to see people reorient and valuation expectations recalibrate.
How long do you stay in a company once it's gone public?
Yeah, it's hard to generalize, but look, we like to think about businesses in terms of years, not quarters. And duration is a competitive advantage for us. It's a competitive advantage for CEOs as they try to build something enduring.
How painful is that? And I'm going to bring up a relatively interesting case study of yours. You made your name in many ways, some really incredible bets you made with Soros and the companies that then went public, one of them being Rivian. Now, today is a very good news day for Rivian. Shares are popping about 40% last time I looked because they've done a deal with VW. But it's been pretty painful in the interim. Yeah. How long did you understand that, look, you've got to stay with this company for the long term? RJ is going to get us there, but it's not an overnight success.
Yeah, I think, look, you're going to find out what type of investors you have when things are not going well. I think that the smart CEOs, the right founders, appreciate the value of staying power. There will be missteps, inevitably. There will be execution faults. But I think the onus is on those companies to communicate in a way where they're straightforward and they're clear and they're transparent. That's what being a public company CEO entails. CFO, too.
But part of your staying power probably is driven by really knowing the company well and the market and having a really informed thesis about how you're seeing it. And I think that's important for any investor. for a CEO to really find an investor that understands that space, that does their own work, that actually goes out and talks to the consumers of that product, I think is so important. And so few investors actually do that. But that's really what builds conviction for us, either early stage or later stage.
Yeah.
We can often sell really earlier, or we have to make the choice. With Case Text, with Figure 8, with Gabby, with Future Advisor, we had term sheets to finance it. And the question is, do we finance it and keep going, or do we sell? And is this price the right price? And that's a question that you can only answer if you do the work, just like when you're a public market investor. And it's interesting that, we do see the bad behavior now of investors that were sort of, tourist investors that came in and thought it was just, throw in some money and cook, right? And it's not. It takes a lot of work, and you have to really enjoy the job.
Yeah.
Talking of, startups in actually the going public space, I just got a quick poll for you. We've only got a couple of minutes, but you've got a couple of minutes to have an audience participation moment. I want to ask you a question on what you thought about this Texas exchange, which, of course, I think Citadel's behind it, some other key players. Do you think the newly announced Texas Stock Exchange could potentially compete with the New York Stock Exchange and the NASDAQ? I want you to get voting. Use your phones. Use the QR code. I want to know if you think it's not a chance. We could see some market share move southwest. Companies should welcome the competition. And it's interesting. We've got a few companies, big, privately run companies and publicly run companies moving to Texas. Elon Musk seems behind a lot of them, and I'm sure he might well be a player of taking companies public over there. But Nick, is it good to have competition in the exchange space as well as competition in actually companies going public?
Look, I think innovation, markets, venues, structures, this is all good for markets. It's good for investors. It's healthy for companies. I think what's interesting about the Texas Stock Exchange is twofold. It's one, an attempt to provide public capital to private companies, but it also speaks to some of the onerous burdens of being a public company from a regulatory standpoint on the NYSE or NASDAQ.
Great. And sometimes you need that safety net there. Interestingly, I think we have a few New Yorkers in the room, because the 40%, the majority think there's not a chance that companies are going to move to Texas to go public. But just as we wind up this conversation, I want you both to give a piece of advice to those who are looking at doing their due diligence, who are wanting to perhaps either get into the private space or into, indeed, companies that are about to IPO. What due diligence should they be doing? How to ensure that they're not tourists, as you labeled them, Rebecca?
I think you have to talk to the customers. You have to really understand why the customer, whether it's consumer or enterprise, why the customer is using that product and what their go-to-market motion truly is, and if it can scale.
Might be easier for a Rivian or an Instacart consumer than perhaps some of the more deep in the weeds AI trades. But Nick, as you're out there sort of crossing the T's, dotting the I's on LPs committing to your fund, what's your piece of advice that you're saying to them to commit capital to you? What would you say for the story you're about to tell?
Well, look, I think everything is downstream of competitive advantage. And that's true for investors. It's true for companies. Being aware of your circle of competence and kind of sticking to that is the onus is on investors to do so. If you don't have an edge, you shouldn't be participating.
I agree.
Keep bringing your edges to Bloomberg. Keep coming on Bloomberg Technology and across all of our bandwidth and our platforms. It's been a joy to be with both of you in front of this wonderful audience today. Thank you for your participation as well. We love it. We want to thank Rebecca Lynn and Nick Lancaster. Thank you very much indeed.
Thank you, Caroline.
That was Canvas Ventures, Rebecca Lynn, and Lacoste Global Management, Nick Laster, along with our own Caroline Hyde. Let's get back very quickly and check on shares of Rivian. Actually, we paired much of the incredible gain we saw in Rivian shares after an up to $5 billion deal, JV formation with Volkswagen, giving Volkswagen access to Rivian software in tech. That's a two-day chart, but in the moment, we're up around 27%. Even so, shares trading at their highest level since February. Of course, this is a stock that's had a precipitous, plummetous decline since its November 2021 IPO. We'll continue to track it. That does it, though, for this edition of Bloomberg Technology. But this Friday, we have Vivek Ramaswamy joining me here on Bloomberg Technology following the presidential debates. This is interesting. I've reported that Vivek was an intermediary, a conduit between Elon Musk re-engaging with former President Donald Trump. I'm going to ask Vivek about that, and I'm going to ask him about his ambitions for a position in government should former President Trump gain re-election. This was a pretty big show that we had today. We went really big on the Rivian story. We had fantastic guests in Cox Automotive, but we also can recap on the podcast. Find it on the terminal, online, Apple, Spotify, and also on iHeart and the Bloomberg platforms. Gosh, what a week it's been. Stay with us. This is Bloomberg Technology.